So it's been a great pleasure to work in recent months with all the folks from Wellington, but Andrew Tubman especially has been the leader of the team that we've been working with, and as I mentioned before, they soon will assume management of our public market strategies. Andrew oversees Wellington's endowment and foundation relationships and is well prepared to lead the conversation about portfolio diversification. Andrew?
Thank you, everyone. It's a true privilege to be partnering with CIS, and it's an honor to be here today. I don't know if Drew's still here, but we support both public and private markets at Wellington. So let's get started. We're going to talk about diversification strategies today. Before we kick it off, I'm going to have each of the panelists just spend 1 or 2 minutes introducing themselves, and then we'll talk about what diversification means. We'll talk about how it's being applied today, and then today's markets, which I think is really top of mind for all of you.
Roberto Ish, work at Wellington Management. I'm a portfolio manager and allocator across our suite of multi-strategy hedge funds, and I'm the portfolio manager on the CIS Diversifying Strategies Fund as well.
Tim?
All right. Tim Cromer, I work at Payden & Regal, based in Los Angeles. We're approximately $140 billion fixed income specialist, really focused on public fixed income markets. Personally, I work on a lot of the multi-asset global strategies, so strategies that are benchmarked against the US Ag or the global Ag. And then also, in addition to that, I do a lot of LDI, liability-driven investing at the firm for insurance clients or pension funds, which is pretty topical these days. Also, native of Illinois, I grew up not in Chicago, but in Champaign, so glad to be back.
Great. Well, thank you all. So for the next 45 minutes or so, let's talk about diversification strategies. I know Katie and Jack, they're always tough acts to follow, so they kind of hit some of the highlights for us, but maybe we'll dive a little bit deeper into some of them. But maybe diversification means different things to different people. So maybe if each of you could spend a few minutes helping us understand how you think about diversification when you're managing assets. I don't know. Tim, do you want to start?
Sure, happy to kick it off. So given that we at Payden, we are in the public fixed income markets, a lot of our duty is to provide that diversification from an asset allocation point of view. So what we do, first of all, is really work with clients to understand what they're trying to accomplish with the investment that they're entrusting Payden with. So, if it's a traditional 60-40 type of investment where, they don't want to take a lot of risk with their core bond allocation, they just want to try to get a little bit more alpha than the benchmark, and they really want to take more risk in other areas of the portfolio, then that's what we try to do with our investments. Whereas we have high yield investments where we understand that clients are trying to take a little bit more risk, they have more room for mark-to-market losses, and they're less concerned about that type of volatility on that investment. So it's really first and foremost understanding what the clients want from diversification. And then once we get the portfolio, diversification means a lot of different things to us. So, first and foremost, we understand that a lot of the public fixed income market has a very asymmetric risk return profile where the upside is usually just the coupon. Now it's a little bit more than the coupon, but historically it's been the coupon. Then the downside, if you buy something that goes into default, the downside's much larger. So having that issuer diversification is a big thing in our portfolios. In addition to that issuer diversification from just a line item perspective in the portfolios, we also look at liquidity diversification in the portfolio. So we understand that our clients look at our investment that they put with Payden as a liquid part of their allocation usually. So we want to be able to meet those liquidity needs and have enough investments to be able to do that and not have to change the construction of our portfolio in a material way where we have to sell treasuries and then we're stuck with less liquid securities in the portfolio.
That's great. I want to come back to liquidity in a few minutes, but maybe, Roberto, we can go to you. How do you think about diversifying strategies? You wear a couple of different roles at the firm as well.
I was joking with Katie when I came up here. I wish she was still back here because she, I think, already answered half these questions and used terms that I'm going to use. So I'll try to switch it up a little bit. So another word that I think about when I think of diversification is dimensionality. So what other dimension can we bring to this portfolio? And ultimately, what role is that dimension going to play? And Katie mentioned roles, and I think that for me is the biggest part. When considering your portfolio holistically, and you're allocating to a different asset class or a different strategy within an asset class, what is the role you're asking for it to play? And that's really how we think about setting up our multi-strategy portfolios and ultimately the role that an alternative asset class or an alternative strategy can play in your plans and endowments.
So lots of different ways to think about diversification. The private credit market is certainly one aspect. Let's step back and pivot to asset classes a little bit. And Roberto, maybe we can turn to you in your role as both a portfolio manager as well as terms of an asset allocator. How do you think about that? Or how should investment committees think about allocating to alternatives, given they can be more complex investments, they have different transparency, different liquidity? How do you think about that? Or how would you recommend or advise investment committees to think about that topic?
Sure. I struggle when we think about it from an asset class perspective, and Drew made this comment when he was talking about the private markets. There are different kinds of private markets. There are different kinds of alternatives, and there's going to be fixed income in alternatives, there's going to be equities in alternatives, there's going to be commodities in alternatives. So as an asset class, it's really tough, but if I bring it up a level, when I'm thinking about it from designing a multi-strategy solution, we use this framework in our manager research as to who we're going to allocate to. And I think if you bring that up a level, you could still think about that when allocating to different types of strategies. And so we think about role, risk, and then residual. And residual is really more of an evaluation of skill. But those first two parts, the role and the risk, I think is what we need to focus on the most. And in particular, if you take a sub-asset class within alternatives of something like hedge funds, different types of hedge funds are going to provide a different type of role. And so we think about role really in four categories. One, which is usually the most common, is total return enhancement. How do I get my overall total return level higher? Number two would be return consistency. Is this something that I can bank on where typically it's going to have consistent positive returns to compound off of? Then we have diversification, which is probably, if I had to step back for alternatives broadly, is one of those primary things that investors are looking for when they go to the alternative side. And lastly, and often overlooked, and I think unfortunately what people end up being the most disappointed by in alternatives is this idea of having a risk mitigation or a downside mitigation property to it. And I feel like oftentimes when we speak with clients and they're thinking about their allocation to alternatives and or hedge funds, it's that last part where they think it implicitly came with a hedge fund allocation, but it depends on the type of hedge fund and whether or not it's going to have that downside mitigating property.
So when we're talking about hedge funds, maybe we'll just stick with you for a second. How should committees be thinking about looking at hedge funds? Are there certain differences versus equities or fixed income? Or how might you recommend you evaluate a hedge fund?
Sure. So it comes with a few additional risks to it, right? Number one is, unlike just a long-only public equity strategy or a long-only fixed income strategy, there is also a little bit of a liquidity premium or a liquidity risk that you have to take on. It might be monthly liquidity, it might be quarterly. Some hedge funds might actually have semi-annual. So it is a little different and not something you can get in and out of in a day. The other part to it is it comes with a little bit more complexity. And so from a due diligence perspective, there is a lot of additional work you have to do to really understand what you're getting from a hedge fund allocation. However, from a role perspective, you have to think about it in terms of how it fits with the other allocations you've made in your portfolio. How much you have in equities, how much you have in fixed income, how much you have in credit, how much you have in privates. And I think there's a role for every one of those segments of the market because each and every one of them are going to add dimensionality and have a potential to play an important part in your overall return pattern. But you really have to spend time to understand what is that return pattern I'm getting when I make an allocation to that hedge fund, and what are the risks that I take on if I say, I make this allocation to this hedge fund and I want total return enhancing, and somehow I also want drawdown mitigating properties. And there are a few of those out there. There are not many. Some of them are unfortunately closed to capacity because of the success they've had. But the idea is to really understand, and sorry to sound like a broken record, but what is that return pattern that you're getting, and what is the role you want it to play in regards to your overall plan?
Great. You mentioned liquidity. Tim, you mentioned liquidity in the beginning. Maybe we should pivot to that and talk a little bit about today's markets, what you're seeing in liquidity, how is it impacting the fixed income market? But Tim, why don't we start with you?
Sure. In the fixed income market, there's been a lot of innovation over the last 10 to 15 years that has added significant liquidity to the fixed income universe. On the trading side, we've had electronic platforms come in. We have had what's called portfolio trading that utilizes ETFs to provide liquidity for the market. All of those things have really benefited fixed income. So I would say that liquidity on a whole is generally better than what we've seen if you go back pre-financial crisis. A lot of people will look at fixed income and say, it's less liquid because the broker-dealers aren't putting as much of their balance sheet to work because of increased regulation at the banks. But these other players have done a great job of stepping into the public fixed income market and adding that liquidity. So in general, we find it to be a very liquid market. There are times, though, where in periods of stress, and we've seen it, in the previous panel is mentioned about what happened in the UK with the pension crisis. In periods of stress and when people need liquidity in their portfolios, they generally do try to sell the highest dollar price security that even though spreads might have blown out significantly on those short-term assets that have that highest dollar price. And in those scenarios, you can see everybody flood to the same things to try to sell, and you can see illiquidity creep back into the market. And that gets reflected in price. It doesn't necessarily stop the volumes from going through, but you are going to have to trade at lower prices to get that liquidity. So I think the market is better at adjusting themselves to provide liquidity. It's just, are you expecting to get the same price for that liquidity? Or are you willing to go down in price to get that liquidity? So the cost of it might have gone up a little bit.
And so how has that been over the last couple of weeks? I know the first panel was really talking big strategic 5, 10, 20 years, but obviously there's been so much volatility over the last 2 or 3 weeks. What have you seen? Are people hiding in the short end? Are they going longer out? I know that's a question you're getting from a lot of your clients.
Yeah, so in the last couple weeks, luckily, most of the clients have been sitting on a lot of cash. So they haven't been forced sellers in this market sell-off. More so, it's generally people trying to get in front of trades. So you saw that specifically the banks that got in trouble, like Silicon Valley Bank, they got in trouble because they had mortgage-backed securities on their balance sheet that were AAA rated. Regulators wanted them to have those securities, but they didn't know that, or hopefully they knew, but they didn't recognize the risk with extension risk that those securities have when interest rates go up. So they ended up having those securities. So the expectation was that a lot of banks were in a similar position. They were going to be forced to sell those types of securities to get liquidity because of deposit outflows. But in reality, it didn't happen. But in the meantime, you did see traders go out and portfolio managers try to sell some agency MBS in front of it to get in front of that trend. So you saw prices reflect that once again, but the volatility didn't necessarily keep people from being able to trade. It just adjusted prices again. So unless we see big outflows from fixed income, the liquidity's been there over the last couple weeks.
Great, right, thanks. Roberto, let's pivot to you, talk a little bit about CIS diversifying strategies in this environment. Where do you see some of the risks? Where do you see the opportunities? What have the last few weeks meant to you?
Well, I think it was said earlier, volatility is back. And volatility, if you can weather it, does create a lot of opportunities. And I can agree with Katie. I very much think we're entering an environment with higher rates and higher rate vol, where dispersion has the ability to come back within asset classes, it should be a more fruitful environment from taking advantage of that for generating alpha, whether that be through stock selection or credit selection. And if you are in an alternative asset class where you can take advantage of not just that dispersion on the long side, but the dispersion on the short side, you can still generate attractive returns. The last 2 weeks in particular, I think, have highlighted that even though there might be some macro undercurrents that are very favorable to certain asset classes versus others, if you think of rising rates or financials, you are going to get to a point where it's not as good for all financials, right? So the initial tidal wave that said, hey, banks, financials, diversified financials, and even insurers are going to go up as rates are going up, and they did throughout 2022, especially relative to the market. And now all of a sudden you have a lot of dispersion picking within financials. You know, what is the difference between the big banks, the regional banks? What's going to be different between a broker like a Schwab versus something like an American Express, for example? So I think there's a lot of extra chance for opportunities. And honestly, what's been, I think, a little bit of a headwind, as we mentioned in the last panel, over the last 10 years or so, when the equity markets are just going up and to the right, it's more of a narrow market. So even if you are a really good stock picker, you just didn't have a lot of chances to differentiate yourself. And the fundamentals maybe didn't even matter as much. You just needed exposure to things that were supposed to be growing at ridiculous rates in perpetuity. And then all of a sudden that environment changed.
So Brendan, you talked about some of the return challenges in your space near term. Roberto touched on the current environment. How do you think about the return potential in fixed income, over the next 1, 3, 5 years?
Okay. For fixed income, there's going to be a difference between nominal versus inflation adjusted. So a big part of it is going to be driven by what your expectations of inflation are going forward on that inflation adjusted side of things. From a nominal perspective, I think coupon plus is a decent starting point for expectations in fixed income. And when you look at investment grade assets within fixed income, so safe, liquid parts of the market, you can look at 5% type of nominal rates of return. I think if you lock it in now with where 10-year yields are and where spreads are, you can lock that in for up to 5 years, potentially 10 years. And then you could get some upside from that if we see some price appreciation and spreads tighten on investment grade as we move forward. On the inflation side of things, I think it's going to cause a lot of volatility in government bond yields over the next year as the Fed and other central banks continue to work through their fight against inflation. Ultimately, our base case is that in the near term, the Fed is going to have to be a lot more hawkish than what the markets are anticipating. So the fact that there's 4 cuts priced in by the end of the year, we're definitely not in that camp. So we do think there's some repricing of government bond yields as the market sees inflation being more sticky. So in the near term, I think that could adjust some of the 1-year type of returns as you see interest rates go up. But then going forward, I think inflation is going to come down, and there's a lot of things out there that are going to be deflationary. There's still a ton of central bank balance sheet out there that they need to work out of, 22 trillion. It's close to 100% of GDP over in Europe. It's 40% here. It's over 100% in Japan. Those are deflationary forces that are going to impact the markets longer term. And I think that it will be longer term easier to get back to that 2% area on inflation. So when you look out, you could get 3%, maybe 4% on it from an inflation adjusted return perspective, which is attractive versus what we've been used to over the last 10 years.
I think just to chime in, because I think I mentioned dimensionality earlier, and there really is a role for all these different types of asset classes. I think if we thought about will fixed income protect now that we're in a different environment. Adam mentioned that over the last decade it did a great job. It depends on what the source of fear is, right? So if you have recessionary risk-off fears pushing, treasuries could still hold up really well, just like they did over the last 2 weeks, right? So they can still play that defensive diversifying role. But then if the inflation numbers don't come down and that's what's causing fear and panic, that's where you may need to look somewhere else. So I can't tell you with certainty which one is going to drive the fear this week, let alone over the next year, especially when you have central banks that, relative to 10 years ago or 15 years ago, were in a position to actually be volatility absorbers. Right now, they're actually probably, despite what they want to be, they're probably volatility accelerators. And so I think it's going to be really hard to just say this is the asset class you want to be in, and you want to make sure you have mapped out the roles for the different types of allocations that you're putting into your portfolio.
Great. So before we open up to questions, why don't we take a few minutes for some lightning round Q&A. And I cheated a bit. I asked a bunch of clients these questions, so you may have heard them before. But Roberto, what about you? What about this idea of higher cash balances for alternatives? How does that play into your investments today?
Sure. So I think part of it is a little bit of a misconception, at least in the hedge fund side, that the cost of leverage has gone up. I think if you're thinking about just purely directionality, I need to get longer, I need to borrow from a bank, or I need to do something which is obviously going to be charging higher rates, the cost of leverage has gone up. If you're looking to deploy more gross, if you're looking to take advantage of some of the dispersion and the idiosyncratic opportunities between longs and shorts, it actually hasn't changed that much materially, all else held equal, because you are going to get rebates on shorting, cash equities, cash bonds, et cetera. And that's actually more contractual with your prime brokers. So from our perspective, talking to our underlying risk takers, despite the very rapid increase in interest rates over the last year, we're not noticing that it's any different to carry the same level of gross or additional gross as we see more opportunities, withstanding that we're not trying to go over 100% net long.
Tim, what about this hiking cycle? So the Fed's been hiking now pretty aggressively. Is this different than the past? How is this hiking cycle different? Balance sheets are different. Any thoughts on that?
Yes, we think it's a lot different than in the past because the Fed and other central banks have accumulated these huge balance sheets. And what you're seeing, you saw some pain in the public markets with Silicon Valley Bank, but most of that pain is actually being felt by the central banks. So they're sitting on these treasury securities, these agency MBS securities that have gone down in price significantly as rates have risen. So they're absorbing it in a non-mark-to-market vehicle that really doesn't cause any blow-ups in the market, whereas in the past, when they weren't doing that, you were getting blow-ups a lot more rapidly in a hiking cycle like LTCM, the savings and loan crisis, things like that, where it happened a lot quicker and those excesses got worked out. We think that this balance sheet is going to protect more of those blow-ups from happening. So hiking is not going to be as effective as it has been in the past, and they are going to have to keep rates high for longer than what the market's expecting, and that's our reason for thinking that the fact that the market has moved to 4 rate cuts by the end of this year is really not fathomable in our opinion. So it's a really tough. They have a really tough mandate right now because of this side of things, fighting inflation. And then also now with financial stability and making sure that they maintain that financial stability, because now over the last week we've seen their balance sheet go up by almost $800 billion or something crazy, whereas it almost wipes out all of the contraction in their Fed balance sheet that we saw once they started the QT.
Great. So one last question for each of you, and then we'll open it up to questions from the audience. Biggest area you're researching today and you're most excited about, and the biggest thing you're most concerned about? Start with you, Tim.
All right.
He's a fixed income guy, so, you know. We
Fixed income, I'll probably be the most boring of you. So in our world, I think the agency MBS market is a really interesting one, and I think that especially in the boring world of core bond and ag portfolios, I think agency MBS is at one of its most interesting points in time in a long period, and that's because of all these different dynamics that are working out in the market. So you have a bunch of agency MBS that has been issued over the last 10 years that has been issued with 2.5%, 3% coupon, and the Fed has been a huge buyer of that. Banks have been incentivized to buy that because regulations have forced them into AAA securities. And that's created this imbalance in the agency MBS market where the low coupon securities face really difficult technicals moving forward because it's held by institutions that might have to sell them at some point. Whereas the larger coupons that are issued today, there's not as much supply coming out of it, and the banks and the Fed are not buying those, so money managers have to absorb it. And all of these factors have led to a cheapening of the asset class, and it's much more attractive for investors now because of those dynamics. And plus, you have to think about, there's not much more extension risk that can happen in the agency MBS market. It's already, those 2.5%, 3% coupons, nobody's refinancing those into a 6% mortgage or 7% mortgage. They're gonna hang on to them. So the securities in agency MBS are at their max duration. So now you're actually getting, some upside from a price perspective, whereas before you had to deal with negative convexity and what happens if rates go up. You really could be hurt. So I think that's an area we're really excited about.
And most concern?
Most concern? I think the illiquid parts of securitized markets, specifically commercial real estate, are an area to watch out for. Office space is troubled in a lot of the metropolitan areas. And I think there's just going to be a lot of institutions, like we've seen Brookfield walk away from assets in certain areas. And I think that's going to continue. So you really have to be cautious on the securities that you pick in that area.
Roberto, most excited about? What's keeping you up at night?
Sure. I would say one area we're researching with adding dimensionality across our risk takers is finding folks who have almost like a different investment horizon. Everyone kind of thinks about themselves as medium or long term, but there are folks that we are working with, especially on the macro side, either macro equities or within rates and FX, that seem to be a lot more short term, almost trading like. And the volatility that's being introduced into the market over the last year and will probably continue for the time being, it actually creates a really rich environment for them to be able to take advantage of quick dislocations, markets overreacting to a data point, and actually have multiple opportunities over the course of the year to maybe rinse and repeat on the same thesis. And that dimensionality of time horizon diversification is something that I think will also lead to better risk-adjusted returns. Kind of a counterpoint to that in terms of what keeps me up at night is just if we do continue to be in the space where the market essentially just trades on one or two macroeconomic data points. Is our rates going up or are rates going down? Is oil up? Is oil down? That leads to those narrow markets we referenced earlier, and that makes it hard to get additional total return from alpha being generated through spread trading, stock selection, et cetera.
Terrific. Why don't we pause here and open to the audience for any questions?
Tim, you were talking about, I think you were saying the coming year, a fair amount of volatility. And does that mean to you in terms, I know when you have money, sometimes you have to deploy it on a new mandate, but are you looking for opportunistic entry points over the coming year because of your statement and your thesis?
For sure. Definitely, you're going to have to be more active with your portfolios trading to try to capitalize on that volatility. And we've been carrying a little bit more dry powder than usual to have ready to deploy in those bouts of volatility. So We think that ultimately this is going to prove to be a good entry point into a lot of these fixed income asset classes for a lot of different reasons. So you want to eventually deploy that capital over the year, but you want to be cautiously doing it because I think there's going to be some significant bumps in the road as the Fed tries to thread the needle with their policy.
Brendan, you mentioned the risk in the commercial mortgage market. How do you think that plays out? Is it kind of a slow burn? And sort of, can you put some kind of magnitude on sort of the risk attached to that?
I am a little jet lagged from a long flight, but I do not remember talking about commercial mortgages.
I think that was Tim.
Yeah, I brought that up.
It's possible I said it.
Sorry, could you repeat the question? When you went to Brendan.
The risk, I mean, we all, I think, are aware of the risk in the commercial mortgage market, especially in metro markets, as you mentioned. How do you think this plays out? Is it a slow burn? And kind of, can you size this in terms of magnitude? How much of a stress could this be in the markets?
I think it's going to be a slow burn more than anything. The good thing about a lot of these structures that have been put in place and loan documents is they allow for a lot of flexibility. So, institutions that own these properties are only going to walk away from them when they don't see any upside potential, and they have means available via the documents to kick the can down the road, per se, and live to fight another day. So I think they'll try to do that as long as they see some opportunity. And that might, that might push it into next year. Who knows? People might not feel pain. So I think it'll be more of a slow burn than it's going to be like overnight we wake up and we see a ton of headlines that are going to frighten the market.
Just thinking about Catholic pools of money and the screening that's gone into many of these pools, whether it be negative or positive screening, there's been a tracking error. But has that provided any insulation over the past year? Is that a diversification strategy to think about impact ESG screening? Or has it cut both ways on the tracking error?
As far as tracking error goes, the benchmarks have been really volatile. So, the tracking error versus a benchmark, hasn't been for managers who have been somewhat conservative. The tracking errors are understandable because of that volatility. I think, just to speak from fixed income manager perspective, there have been some institution and competitors where the historically low tracking errors kind of hid the risk that was in their portfolios. And over the last year, given all this volatility, they've underperformed significantly versus their benchmarks. And I think that that's one of the errors that people have exposed themselves to by looking at historical tracking error versus looking at actual exposures and portfolios, stress testing them, and seeing how they can perform in a tough market. And people have been exposed as having too much risk in the portfolio, and they haven't performed like a core bond manager should perform, per se.
I would say the other piece to it is you have to step back and think about it on a longer horizon, right? If you look at maybe some of the energy components, which would have been a headwind last year, probably were a tailwind for the decade before that. And so in a way, some of the nuances that come with those restrictions are probably going to ebb and flow. But overall, it's more of making sure that where you are selecting someone to allocate that capital to that has to abide by those restrictions, that they still think they can deliver despite that. And so for us, when we were constructing the Diversifiers Fund with CIS, we were fortunate enough at Wellington where we had a really deep bench, and we could say which of these managers, their process isn't going to be impacted by having this restriction list alongside of them. And we think that it won't affect that total return pattern we're going to get from them. And we can still have confidence, again, sorry for broken record, that they can fulfill the role that I'm hiring them to do.
I'm just interested to know, like, what role, if any, do the Catholic social themes of human dignity, common good, subsidiarity, care of our common home, how do those play into your construction of your portfolios and the diversification strategies that you represent?
You know, I think on our side, it's been made a little bit simpler, right? CIS has provided us with the restriction list. We're not going to argue. It's a lot harder when you have a client that almost wants it both ways, who doesn't want to say, this is what I don't want you to do, but I'm not putting it in writing. I just kind of hold you to that. And then, as we said earlier, when the expectations aren't above board to begin with, somebody's going to be disappointed. So we're really excited about this partnership because our guidelines are very clear. And then internally at Wellington, at least, one of the things that I've been really happy with over the last few years is the ESG discussion is there, and it's really robust. But it's also thinking about the second order effects of some of these ideas and policies, right? If you think from like an environmental perspective and net zero and so forth, I don't think we can get from where we are to net zero without having improvers, which means probably some current offenders, but that are working to get better, right? And so there's been a really robust dialogue about what the impact would be if we say we need no capital going in this direction. Well, I don't know if we have enough of a bridge to get to net zero without some of these existing offenders improving. And so there's been really good dialogue, and I think it's spurred honest debate about who's going to be the winners and who's going to be the losers from some of these trends.
And I think we're going to talk a lot more about that. Scott will have something to say about that in his session, but I think tomorrow is a lot about that, particularly Catholic values and impact investing. So stay tuned.
Other questions?
All right, last call.
Terrific.
Great job.
Thank you.
I wanted to mention that Tim's colleague, Joan Payton, is on our board, and she, let me just say, she puts me through my paces, and she puts all of us through our paces, and she did great. So she's been a great board member and colleague on our board. So again, thank you.